Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS and ESS BIZTOOLS. Welcome to this webinar on setting retail prices calculator for you to be able to use with your clients to guide them through the process of determining their labour budget, reviewing the business's overhead costs, determining an appropriate return based on the investment in the business, and then looking at the mix of products that they are currently selling, what the markups are, to determine if they have the correct sales mix at the correct prices to achieve the profit target. So we look forward to guiding you through this process, and then you will be able to utilize the spreadsheets to be able to undertake this process with your clients. So the first form you go to is just the introduction. You will badge this with your name and your client's name and the date that you have prepared the document. There are some instructions. Which is linked, as you can see, and guides you through the process. We've got calculation of labour on costs, and we have given you maximum flexibility to document individual variations for the team. The system will then calculate the labour budget after you've inserted the salaries being paid, the working hours, and the productivity percentages. And then the system will then move into reviewing the overhead expenses after you've input them, and then calculating the return on investment. Obviously, you need to insert the value of the investment in the business and the rate of return. This will then enable the identification of a gross profit target for this business. This will determine the gross profit percentage that is needed. And then you'll be able to work through the sales mix strategy that's going to be required for this business. So let's move into the calculation of the labour on costs. We've already gone through and partially completed this form. So we've inserted a manager and assistant manager in classification A1. And we've put in details of annual leave, holiday pay loading, etc. So the system can do the calculations. The long service leave, all you have to do is enter the abbreviated state and click on into this column, and the number of days that are being earned on an annual basis from someone working full-time will then be determined. If someone is not working full-time, appropriate adjustments are made in the calculations. And there's calculations then made as to what the total on costs are if they're expressed on an annualised salary. And the budget calculator for labour is picking up all of these costs. Obviously, you can vary them as you see fit. There's opportunity for you to go through and put a wide range of staff classifications, some of which will have variables, maybe on annual leave or on holiday pay loading. Some might not get it. And some people will be able to get a shift worker allowance. So the system has been designed to give you flexibility to insert those details. The labour budget. The information that's been inserted as the classification of the employee and the reference is automatically transferred. What you need to insert is the number of individuals who are performing that role and the salaries on an individual basis. So that's just the gross salaries. The system then transfers the labour on cost percentage from the calculation of labour on cost and will automatically calculate it for an individual person, and also will then show the total individual employment cost and then the total labour cost based on the number of people in that classification. The system also had provision for permanent part-time staff, and we have done the calculations for them on an hourly payment rate. And then we've also got provision for some casual staff, again on an hourly payment basis with the casual loading built into it. So that the system is able to give us a total labour cost, which is coming up at $1,362,272. Now that is including the labour on cost that has been calculated, because that's a cost that's accruing to the business. The budgeted overhead expenses, there's a form prepared that you will need to complete. Obviously you can add expense items if you wish. We then move into the financial analysis. The financial analysis has got three separate segments. The first one is what's the return on investment. You insert what you believe the value of the investment in this business is. We're showing here at $650,000. We've inserted a targeted rate of return of 25%. Therefore, the targeted net profit prior to income tax is $162,500. We then have a Section 5 is looking at the gross profit target. And obviously this comprises the total labour cost, including the labour on cost, the overhead budget, and the profit. When all added together, that is the targeted gross profit for the business. The calculation is then done to determine what is the overall average gross profit that has to be achieved to earn a gross profit of $1,831,000, and that will mean that the sales figure has to be $3,212,000 and a gross profit of 57%. If that's all achieved, the business will show a net profit of $162,000. Sounds easy, doesn't it? But in actual practice, it is very difficult. So we then move into the very interesting area, which is the sales mix. This is an ongoing problem for your clients who are operating retail businesses. It's very rare for a retailer to only be selling one product. They're normally selling a range. So we've made provision here for 32 products. Hopefully that covers what your clients will have. And we've gone through and looked at what's currently happening before this exercise was done. That's what we're doing in example 1. And to explain this, I probably should be using a highlighter. So example 1 is going through and saying, what's the dissection of the sales mix at this stage? What products are they buying? What are the markups? What are the markup dollars? What is the resultant sales figure? So we go through, we got product 1, we got, now in here you can type the name of the product if you wish. We've just used the terminology product numbers, and we have indicated what we believe those products are costing and then what the individual markups the business normally achieves for those particular products. And then we got the total figures. So the total purchases were 1,238,000. The markup ends up at 1,588,000. So the total sales are 2,826,000. So you're then able to do this short P&L type exercise. At sales at 2,826,000 with purchases at 1,238,000, that the gross profit of 1,588,600. The overall gross profit percentage will be 56.2%. Now that's under the targeted figure that's been set. And if you analyse the labour on costs and the budgeted overhead expenses, they add to 1,688,000. So this business is actually showing a minus $80,000. The system then tells you that to meet the overall targeted figure of 162,500, remember from the financial analysis, that's our targeted, at this average gross profit percentage of 56.2%, you're going to have to sell a further $431,000 worth of product to achieve the targeted profit of 162,500. Okay, so what we'll do now is go back and say, well, okay, let's do a further example. We've called it example 2. And in example 2, we have then started to do some playing. So you could do this with your clients saying, well, in product 1, could we increase our purchases to 330%? Because this is a high markup. Will we still get 180%? Client says, okay. That's the markup, the sales, and the system's automatically calculating what the gross profit percentage is. So overall, you're making 64%. So that's your best selling line on gross profit basis, and obviously markup. Could you sell more of it? At this stage, we've got 330,000. Product 2, your client might say, no, we can only sell $200,000, and in fact, we've played around with this and we've got the markup's only 130% this time round. The next one, we've got the 200,000, but we've increased the markup a little bit to 125%. And the same thing in the next product line. We've kept the overall purchases the same at 200,000, but we think by some in-store marketing and some other changes, we can probably get the markup up to 140%. The next one, we've got the same purchases, 90 grand. In fact, we're really saying we can't do much with that. Management's telling you they need those products, so they're staying the same. The next one, we're buying a little bit more, 5 grand more. We've got the same markup percentage. You might ask yourself whether they really need that product at all, but that's another question. Same with the next lot. So let's look at the overall result of what we've achieved here. We've made some changes because overall the purchases have gone from 1,238,000 to 1,381, but the gross profit's now 1,831,000 as compared to 1,588, and the sales figures increased from 2.8 million to 3.2. Now we only made a couple of subtle changes there, primarily looked at the biggest selling item and said to your client if they adopted some aggressive marketing tactics, maybe digital marketing where they're really trying to zero in on people that might be interested in their products, what could result? We've now got an overall gross profit percentage of 57%. That's what we were trying to achieve, wasn't it? And let's look at the calculation now. It's saying that we've got overhead expenses of $306,000. We're assuming there's been no changes in that area, and there shouldn't be, just one sales mix to another. The labour and on cost hasn't changed either. In some instances, maybe there could have been some tinkering with the labour costs because of different ways of selling or marketing that might be required, but we're assuming that's remained constant. So our overheads and labours remained the same at 1,668 million, but we've now got a net profit of 163,000. And in fact, the sales differentials in effect to sell $961 less of this product will achieve the profitability target of 162,500. So at this stage, you're able to say to your client, if you're able to achieve what's in example 2, in buying these products and getting this sales mix, you'll be able to achieve your stated net profit target of $162,000. Now, I think you know what the next question is going to be from your client. Could we do better than that? It's been my experience that whenever I've done these exercises, the clients then turn around and say, well, that looks very interesting. Could we even go better? So we've used example 3 as the basis for you to have that conversation with your client and say, well, hang on, could we go better? So we've slightly improved the purchases in product 1, but we've improved the margin by 5% to 185. So the sales are now going to be 986, up 60-odd thousand. Product number 2, we're saying we'll buy a little bit more of that and we're going to get 5% more. So we're going to do some negotiations with suppliers and try to probably buy a little bit cheaper. Or we're going to do some in-store promotions and try to improve these margins a bit. The next one, we've increased the purchases a little bit, but we've left the margin the same. You can't just increase every margin, and you need to tell your client that. The next one, everything's exactly the same. $200,000 worth of purchases, 140% markup. The next one, we're going to buy a little bit more, and we're going to get 5% more in selling the product. The next one, we're going to buy a little bit more. We're going to move the price markup up by 5%, really tinkering at the edges. And let's look at what the result's going to be when we get there. We're going to buy a little bit more of this product, but we're going to try to get 5% more when we sell it. Now this one here was our lowest markup at 75%. We've decided to recommend to the client that they don't get that. A 75% markup is only showing a 43% gross profit percentage. This business is aiming for 57%. Our recommendation to the client's been wipe that. Don't run that stock in your store. This next one, we were only buying $45,000 previously. We've worked out where we can get some more product. We're going to buy $100,000. And bingo, we're going to get 10% more in the margin. We're going to end up with 120% markup. And the last one, we're going to buy a bit more and we're going to get 10% more also. And obviously all this is just an example, so you can get your client to start thinking about all this. So what's it done down the bottom here? I'll put that there so we can see the total screen. It's saying that our purchases have now gone to 1,401,000. They were 1,381. They really haven't gone up that much. And the markup's gone from 1.83 million to 1.965 million. So there's a substantial increase there. And turnover's now at 3,366,000 instead of 3,212,000, or at 2.82 million before you started having these conversations with your client. So what's it all mean? We've got sales of 3.3 million. We've got purchases of 1.401. Our gross profit is now 1965. We're going to achieve a higher gross profit than what percentage than what was being targeted, 58.39%. The target was 57. There's the financial figures, and gee, look at this. We are going to make a net profit of 297,000. Our target's only 162,000, about $130,000 more profit. That's really come about by just tinkering at the edges and trying to say to your client, if you really worked hard, can you get a bit more money for some of these products? Can you buy a bit more of it? And then see what the results are within your business. So in fact, our little calculation says here, we could sell $230,000 less of this product at 58.3% to achieve the $162,500 profit target. But why would you do that? Your client can now see how they can make $297,000. So next year in their targets, that should be the minimum target they're looking for, not $162,500. I hope you're going to have great fun playing with this chart and identifying to your client how, if they think outside the square a bit, they can achieve great things. So this final example here is really saying, what's the client going to do? Well, we're saying, I believe the client would select strategy 3. They want sales now at 3.36 million. They want to make a 58.39% gross profit percentage. And as long as they can do all of that without increasing their labour, their overhead expenses shouldn't increase, unless they have some more advertising or digital marketing or something like that. But if so, you'd adjust for that. And that should earn them a profit of $297,000 as compared to their original figure of $162,000. So what's been achieved out of this chart as a budget forecast aid for a retailer? You've helped them to work through who their staff are. These expenses are including all of their wage on costs. Too many businesses forget that and don't factor it into their selling prices. It's now been factored into the selling prices. The overhead expenses have been calculated. The labour budget's been determined, and the business owner can get an idea based on the various components of their purchases, what they need to buy more of, what they need to buy less of, whether they need to go and have a conversation with suppliers to try to get a better deal, and whether some changes in their marketing and selling philosophies will enable them to sell more of a particular product, especially the one that they're going to get the high markup from. So hopefully that will help you. The other material that's contained in here, over the years I've had clients that have had difficulty in understanding the difference between the markup percentages on purchases and the gross profit percentage on sales. So we've developed a chart that you can just show them so they understand the differences. I've had a couple of instances over the years where clients have got themselves into some difficulty by using the markup percentage figures and thinking that was the gross profit percentage. So they thought they were making a gross profit of 100%, where they were only marking up the goods by 100%. Hell of a difference. The other calculator we got here, I referred to this earlier. This is the long service leave calculated. They're the codes for the various states and territories that you can insert, and you can see that we've already done the calculation based on the leave, long service leave per annum that has been accrued based on each year of service by an employee. So to finish off, I'm just taking you back to the sales mix chart. I hope you're able to use this to assist your clients to better think through their retail businesses to work out what are their star items, what are their stars, what are their cash cows, and I identify their problem mines. And the first instance should be to get rid of the problem mines and then really look at the overall mix to see whether it can be engineered differently so that a different financial result can be achieved. And you'll notice from these figures that you don't have to do too much fine tuning to achieve some significant changes. Thank you very much for your support of ESS BizTools. If you have any questions on any aspect of the retail price calculator, please do not hesitate to contact us. Have a great day. Goodbye.